In about 60 minutes, as the market opens, I've got three stocks, these ones right here, SPCE, ASTS, and KMX, that are likely to create trades that have a 70% chance of winning. Not immediately, but over the next few days. I want to take you through each one of these trades and show you which one I think is the best and why it could yield a trade or two that is worth your time. But before we get into that, I'm also going to talk about where the market is likely to open. The US market is likely to drift a little higher, and I'm going to show you why I think that and how that's going to help these trades improve their chances of winning. This is all the kind of thing I'm going to be covering in the class I'll be teaching next week. I hope you'll get a chance to attend that. But let me share my screen and we'll look closer at how this is going to work out. And we'll just go here and here. Remind that. Remind me later on that and that. Okay, here's the three, the same chart we were looking at before. Let's make sure that that is um, something everybody's seeing. If you want to chat in, or if you could tell me, am I looking at the right screen? You, you see that okay? Okay, all right. Let me get the chat window up so that I can, yes, thank you, Helen. Okay, so last week we had a lot of fun because we put up Smith and Wesson, and when the market opened, boom, up it went. Right now, I kind of doubt that this experience or the today's trades are going to do the same thing. In fact, I think all three of them are likely to do what's more typical with these gap up trades. But let me walk through what the gap up trade is real quick for those of you that haven't heard it. And then I want to set up how the market's going and then the really interesting information on all three of these trades. And then we'll set up a paper trade and walk through how each one of these could be approached for someone who is following the gap trade. All right, first off, the gap trade is something that comes from a study published in the Journal of Technical Analysis back in 2013. 8 years ago is when they published the study. The study was done on data that started, or I should say, that ended 2 years previous to that, 2011, and then went back 10 years from there. So think about that. That's 2001 to 2011, right? And if you think about the price action during that period of time from 2001 to 2011, you have two bear markets and two recoveries from both of those. And in those periods of time, you have almost every single kind of uh, price action that the market has generally ever shown. That is, you have volatile bear market moves, you have quiet bull market moves, then you have um, quiet bear market moves and um, volatile bull market moves, and you have some sideways stuff, right? Um, but uh, but yeah, okay, fine. But those gaps that occur on each of the stocks going through that period of time, then they're drawn from all the different kinds of markets. And that's kind of the big point here, is that the study was able to show what happens on gap trades, on gap stocks that jump up between one day to the next, and not so much what happens on the day itself, but what happens on the next day and the 20 trading days that follow for a month after the gap. The great thing about the study is it gave us enough data to understand how to approach these trades and why they are such a good trade. They have a high probability of beating the U.S. market, the S&P 500, um, when you approach them from the day after the gap. So that's amazing. People are like, well, I mean, it gaps and it goes up. Yeah, I wish I could have bought the day before all that. Of course, we all do. But what most people don't recognize is that that is predictive of continuing improved returns. So much so that this sort of gap system trade has been persistent even since 2013 until now as a way to grab winning trades. And I've been doing this for years and I'm happy to show other people how to do this. Is it a guaranteed winner? Of course not. But that's why I like to set up trades that have a 70% or so chance of winning and use these kinds of trades specifically to consistently try to generate outsized returns. Okay, quick quick disclaimer screen here, if I can show that, just so that that can be put on as part of the recording. Let me go there and this. All right. Now, while I'm explaining to you that there are um, three different trades: SPCE, which is Virgin Galactic, KMX, which is CarMax, and another stock you probably have never heard of before, ASTS. Let me just, recognize there, I'm not a licensed financial advisor. I'm not giving you financial advice. Any one person that I'm talking to specifically, I'm not giving you financial advice. I am giving you trade ideas for education purposes only. So just remember that. Trade at your own risk. Okay, why these three trades? Let me show you where I got them and then how I'm going to approach trading them. Now, there are a variety of ways that you can approach these. And there are a lot of other kinds of trades you can sort out for yourself. This is the kind of thing that I go into complete depth with in the class that I will be teaching on the 4th of July, next weekend. Okay. I want to tell you that I know it's self-promotion because I'm getting paid to teach this class. But I want to tell you that this is probably the most useful class that I will have ever taught. And I'm really excited to offer it through Actions to Wealth because they figured out a way that they could monetize the advertising of it and so forth. That gives them the ability to offer it inexpensively. I have taught this information before in ways that people have paid many thousands of dollars to receive. And I mean, just the marketing and so forth, it took that much to be able to get this information offered to people. But here, Actions 12 has got this for under $500, and I think they're even running some special discount. I don't know, but I'm actually excited about that because this is probably the most effective uh, trading education learning package style information ever I've put together. And I know it works with people. I know that people who take this have a higher percentage of improving their trading than than most of the education, than almost all of the education that's out there, because I'm able to. Thanks. Because I've been able to track some of the performances of the people that I've worked with one on one who've had this education. Shukri chats in and says, "You're not celebrating Independence Day." Oh, yes, I am. Of course. How else could I better celebrate Independence Day than talking about how people can take a better approach to trading and establish their own independence? See what I did there? Yeah. Okay. Anyway, yeah, I'm that's the day that worked in best with people listening. So yeah, I'm gonna go do it, and it's gonna be fun. I'm really looking forward to it. I think we're gonna see our own version of fireworks. Ooh, see what I did there too. Okay. But speaking of fireworks, these trades themselves are worth talking about because I think they're going to give us some exciting pops. Now, where do I get these trades from? Let me give you the quick rundown of, well, actually, you know what? Before we do that, I want to first give you a blink at how the markets are setting up. I've got my trusty comparison between the Nasdaq and the Aussie yen on the screen here right now. As you can see, starting back here, this is the beginning of the weekend. This is the 5 minute version of this. Beginning of the weekend of the Aussie yen, it gapped down, jumped up, and then has drifted down ever since. So we got the Aussie yen going down, but the Nasdaq heading up. The Nasdaq gapped up, started to fill, did not fill over the weekend yet. These are the Nasdaq futures, and they are heading higher. These are in real time, by the way. This is not delayed data. Sometimes I've showed this chart with delayed data, but not today. I wanted to, so I'm bringing it up here in this Thinkorswim account so that it's actual real time live data. Okay, there you go. So we've got a divergence. We've got the Nasdaq going higher, the Aussie yen going lower. These are 75% correlated persistently over time. When they diverge like this, it is always a case of something's got to give. One of these is going to turn around and catch up to the other. Now they can stay diverged for several days, so it's not like they have to, get back in line. They rarely ever go perfectly in sync, but they generally trend in a way that follows each other. So if they're diverging, pretty soon one of them has to snap around. Either the Nasdaq, in this case, will come down, or the Aussie yen will come up. Um, my guess is that the Nasdaq is going to continue drifting higher today. There'll be a little volatility at the beginning, but it will continue drifting higher today. And the Aussie yen will actually kind of drift lower. The divergence will continue even after the market opens, but then they'll sort of sync up through the rest of the day, and either head down or go up, whatever they're going to do. I don't have a crystal ball. I do not know the future, but I make guesses because that's fun and it gives me a chance to sort of take a shot. That's kind of the thing, when you're trading, you don't know what's going to happen, and it's really important that you remind yourself, I do not know the future. Because if I thought I knew the future, the actions I would take would, well, not necessarily be losers, but they would be um, high risk. That is the inappropriate risk. That's the words I'm searching for. They'd be inappropriate risk because what they would do is they would lead me to say, I know where this is going. I'm going to put all my money here and have it go. Um, but instead, it's better for a trader to take the approach and say, I don't know where it's going to go. But statistically, I believe I have an edge with the kind of trade I'm doing. And so I'm going to take a shot. And I'm just going to keep my bet size small and controlled to a certain amount. Because over time, statistically, this edge that I have should manifest itself, should play out with improved returns, outsized returns, better returns than what the market has. If I can get that strategy down and repeat it faster, that is frequently, then I can beat the market very significantly, right? That's the whole approach of trading, right? So uh, it's better that I approach the markets as if I don't know the future, even if I think I do know the future. I remember I had somebody, one of the individuals I coached one on one, say to me, uh, Gordon, I prayed about it. I believe God told me this is what's going to happen tomorrow. I'm like, okay. Um, I can respect anybody's point of view. I mean, who am I to say uh, what is and what isn't? However, um, the great thing about the market is that you are immediately faced with a certain reality that plays out in real time, and you have to adjust to it, right? And so I said to this person, that might be true, that that you have this feeling and that it will play out the way you expect for whatever reason. I'm not going to try to judge it, but I would recommend to you that the way you go about setting up the trade is as if you didn't know it was going to happen. I think statistically over time, you will have a better chance of trading well by doing that. And that was my recommendation. And what happened, and I did not follow up. I don't honestly know. Yeah. Um, you know, what happened with that trade. Um, there's a lot longer story there. But sorry, I don't have time to share it today. I got to get to these three trades, which I think you're gonna like. So my favorite trade is the gap trade. My second favorite trade, which is more frequent and the trade I actually take more often, is the tall range trade. I think we talked a little bit about that last week. The Smith and Wesson was both a gap and a tall range trade, and it was fun because when the market opened, we watched it happen and just go right up. Well, this one I did not put on. None of these three trades have I put on already, like I did the Smith and Wesson trade. So instead, I thought I would set up paper trades um, that for all three of these that demonstrate how they could be approached. The thing about each of the gap trades is that study published in the Journal of Technical Analysis showed that there was a 58% chance, that's pretty high for this kind of thing, 58% chance that over the next 5 days, a gap trade will actually pull back. And so it's usually, not always, usually better to try to bargain shop these trades, try to let yourself get a better price than where it closed at the end of the gap, and do a limit order and try to just let the price come back a little bit, grab it there, and then hope you get the move all the way up. um, the Smith and Wesson trade we did last week was not one of those. And even as I said on that one, the very best trades are the ones that follow on, that sort of gap just a little bit more, open up, and then just charge and keep going, right? Those are the best trades because they move the farthest. But and that is exactly what Smith and Wesson did. But that's only 42% of the time that they do begin higher and push higher from there. 58% of the time they're going to they're going to come back. Now, and as far as the 42%, they might go a little higher, but many of them will also retrace. So you really have a less than 30% chance of getting the trade that jumps up and just takes off and keeps going. But that trade is so good, oftentimes you don't want to miss it. That's why putting it on, putting on a trade that is, right at the open, whatever the open is actually a pretty good idea. There's one of these three trades that I think is probably it's smart to do that for, but the other, but really all three of these trades you could be more patient with. It's more likely that all three of them will not behave like Smith and Wesson. Now I could be wrong. I'm going to show you that too. First, let me show you how I found these trades. Well, okay. Is tall range? Does it have the three criteria? Bullish candle, moving average cross, and one more. No, the tall that's the gap trade. Helen asks about these. So the gap trade has um, the, the very best of them. Both the gap and the tall range do not require all three of them in order to be a good trade. The very best trades, though, have all three of those. And Smith and Wesson did have all three of those characteristics. This trade, however, or these three trades, only one, no, none of these have all three characteristics. The closest one is ASTS, but all three, although these trades are all three good trades, they don't have all three. The tall range criteria, I don't try to follow all three of the criteria at all. I just take the fact that it's a tall range. But I love it when I do get the other criteria, crossing over the moving average, and turning a downward trend into an upward trend. Those are my favorite trades. But I recognize statistically you do not need all of those in order to accomplish them. All right, so here's what I searched for on Market Chameleon. Quickly has become my new favorite research site. And full disclosure, I talk with the guys at Market Chameleon, and they are having me write stuff for them. I'll show you where that is really quick here. Reviews, news, news. Under news, there's this thing that says blog. If you click on blog, what comes up? Boom, the article I wrote. Uh, if you look in the archive, um, this last week they started publishing new uh, trade ideas. Now these are trade idea studies. That what did I do? What how did I look at this trade that came from information on their site? They have these really great alert services that are automated. They turn out, this stock's going to do earnings. This stock has unusual volume. This stock has pre-market trading stuff. And what I do then is say, all right, if you got this, then let's look back and see what kind of a trade you could have put into them. That's because I can't get that alert, write the article, and quickly get it out in enough time to those guys to have them like put it up on the site before the market opens so that well, like what we're doing right now, right? There's not enough time to do all that on a daily basis. So instead, I give examples of how these trades could go. All right. Anyway, so and these are completely different trades from the trades I'm going to talk about now. I just wanted to let you know, full disclosure, although I'm talking about this because I love this website, I actually do write for them and get compensated from them. What I'm doing today is not related to that. Just disclosure, that's all. Okay, so what is really fun here is the fact that I'm using their website to do these as a stock screener, not as an options trade. And so the stock screener that I came up with is this one here. My saved preset is uh, I both have a tall range trend change. We looked at that last week, and the positive gap above $10. So this one's very simple. It's just the criteria. As you can see, the two that came up are SPCE and ASTS. And CarMax did not come up. I got that one from my FinViz screen. All right, so hang on a second here. Now, the criteria above $10, over 500,000 normally. I want to make sure the stock volume is up over 100,000. Of course, both the volume on these things are blowing way past that, so no big deal. But the big thing is this: we have opened up more than 2% and we closed higher. It's got to be a green candle, right? Bullish candle that day. And so that's what came up: SPCE and ASTS. Over here on FinViz, this is where I actually developed these screens, and the um, and then Market Chameleon I found more recently was even a better way. And there are actually a number of stocks. See, Nike's way up like that. CarMax, that's the one I selected. As PCE, also on this trade. ASTS is not here because I can't remember what criteria it was that this screen has that didn't. Oh, I think maybe average volume over 750. Probably that one didn't fit in. And so there's lots of these other ones that are pretty good. I picked CarMax out of all of them. Why? Because of that number right there. All right. I'm going to come back and talk about the short ratio in a couple of minutes. But first, let's look at what Market Chameleon tells us about each one of these trades, which is really kind of fun stuff. Because again, why I'm finding this site to be my new favorite research. If you come into if you were to click on SPCE or put it in there, then you can do this thing right here: stock info, price action, and they give you all this nice research. And because SPCE had a gap, well, let me back up here. See, in the pre-market, it can tell you what the VWAP is doing and historically what it's done, what the historical gap up moves and gap down moves. Well, we're talking about gap up, so this is great. Let's see, what does SPCE historically do on the gaps. Now, there's a bunch of stuff I could read through. I'm not going to take the time to do that. Read through that on your own if you ever go to the site. I want to run you right down to these numbers right here. Hopefully you can see these. You can see that this is the one I'm really interested in, after the event date, not including the day of the selected event. The selected event in this case is a gap, okay? So this is the day after the gap. This is fantastic because what they've done is they've taken the last 12 largest positive opening gaps, which are not earnings. Kind of interesting. Most of the time, gaps, big gap trades like this do happen on earnings, but they specifically filtered those out, which is nice because in the case of SPC and ASTS, they are not earnings gaps. This is how did the gap happen? Because of Wall Street bets. Yeah. And why did Wall Street bets pick up on SPCE? Because SPCE has 20% short float. Okay, of all the available shares out there available to be traded, a fifth of them, 20% of them, are short. A bunch of people, and a lot of people think hedge funds are probably the ones doing this, are short Virgin Galactic. And so the Wall Street bet crowd, they're all about the idea of creating a short squeeze. Hey, let's go find these hedge funds that are all, yeah, this stock's terrible. We hate it. It doesn't matter whether the stock is horrible or has no good prospects. What we know, say the Wall Street bet folks, is a bunch of hedge funds are short. And if all of us retailers get in there and buy a bunch of stocks and drive the price up, that will spook those guys. They'll have to get out and they will run the price up as they do because they'll be in a buying frenzy and it'll be a short squeeze and we'll make all this money. Yeah, right. That's kind of the, well, I'm over exaggerating the I mean, how do you? I don't know how you can over exaggerate anything on Wall Street bets because you read it, right, and it's all just this mean, crazy exaggeration of fun stuff, right? But in any event, the thing is, that's the premise. You've got a lot of people short, and if you get them spooked and they come out, then a lot of them have to buy, and you get this buying frenzy and a panic. Most people what happens is you see markets panic where, oh, this is a terrible stock, we got to get out, and then they sell, and it's a selling frenzy. But because short sellers are people that sell first and then buy back later, then the opposite happens, and it's a buying frenzy, right? That's the whole idea behind short squeeze. So um, they Wall Street Bets has been talking about Virgin Galactic (SPCE) as a potential short squeeze play, and it looks like wow, it really happened yesterday. Um, ASTS is also a uh, space exploration, space mobile, space mobile, whatever. And I think it's a follow-on trade. I think people are kind of interested in ASTS because it's somehow similar or related to Virgin Galactic. Whether or not it actually is, I don't know. Neither do they. That's the point. People are going after it, right? But there's some real big differences in performance on the days after a gap on ASTS and Virgin Galactic. Look at this. You see, most of the last 12 days, what has happened on that first day on Virgin Galactic SPCE? Well, one, two, three. Only 25% of the time did it go higher. 75% of the time after a gap, this trade went lower. Okay, I told you over 16,000 trades. That was in the Journal of Technical Analysis study. That 58% of the time it goes lower. Virgin Galactic's it's small sample data. It's only 12, but of the 12, it looks ugly. Most of the time, it drops. So that is totally what I would expect to happen. By the end of the first day, you're going to see Virgin Galactic lower uh, the first day after the gap. But look over here, 2 weeks out. 2 weeks out, one, two, three, four, five. 7 out of 5 times it's up. Now there's this one time right here, negative 54%. That 2 weeks after a gap up trade, it went down 54. It was cut in half. The price was cut in half. But go over here and look close. What is that day? That's the pandemic. That was right before the worst part of the pandemic trading activity. So, it dropped by half through that. Of course, you would expect it to drop because the entire market was in this crazy bad panic, super fast, and Virgin Galactic is a speculative stock anyway. So, do we just throw that out? Not necessarily, but it's not indicative of any trading that's come before or since. So there's that. And how about this one? The 36%, same thing. 19th of February, 2 days before the February 22nd was the top where it turned. And the third one, again, same thing. So all three of these big down trader days, they all happened at the at the pandemic. How about these big ones that are coming up? Well, the 22nd of May and the 24th of May, 2021. This is not the pandemic. This is recently, right? And so we don't see. I guess this is right here, up 32%, up 19%. Those are kind of pandemic response trades, right? So yeah, we get some wild stuff going on, but notice the biggest ones are the most recent ones. They're not post pandemic trades. This is kind of recent stuff. So anyway, as I said, small sample data. But even if we were to look at these and recognize that, hey, this thing can move a lot in a month, that's kind of the point. We don't want to necessarily grab all of that. We don't know that it's coming. What we want is a trade that just within the next couple of weeks is going to hit with, give us an edge. And I'm telling you that I think we've got an edge trade here. There will be a chance, there will be some time today where Virgin Galactic will up and down, and you'll be able to get it at a lower price, and that probably within a month from now, you'll have a 70% chance of seeing this trade um, head higher. Uh-oh, sorry, I've got this stuff coming at me here. Slack chat's coming my way. All right, so let's see. And ASTS is connected to that. Now, ASTS numbers look horrible, right? I mean, no, right? They look down. However, ASTS, if it's somehow connected with SPCE, the Wall Street Bets crowd and the sympathy follower honors of this SPCE trade, are going to do with SPCE what they're going to do with ASTS, then ASTS also has that similar chance of going higher. But better than both of these, I believe, is CarMax, KMX. Why do I like CarMax better than SPCE and ASTS? Let me show you this little bit of information right here, the short ratio. Okay. See, what a lot of people look at, there's SPCE, the 20%, huge short float, right? You get over 20%, that's a lot. But what's easy to overlook is the fact that SPCE is trading with crazy high volume, and it always has high volume. And in fact, its average volume rate of trade, 24 million shares a day. When you look at how big the float is and how, the float is 164 million or 169 million, and the float short is 20%. So we take 20% of this and you get about 32, 33 million, right? 33 million shares are short, but it trades at 24 million shares a day on average, 261 last Friday, 10 times its average. So the ratio of how quickly will the short float be done is 1.41 days at the average amount of volume. Okay, so let me be very clear about what those numbers mean. What those numbers mean is that if all of the shorts were to just bail out instantly, looking at the number of shorts that there are and the number of shares that are traded in the day, how long would the short squeeze last? How long would it take for all of those short positions to get out so that they were not short at all? Now, nobody trades all the way in, all the way out, or I mean, that never fully happens, right? But in theory, if they were, how much panic could it push? How long would it last? The answer is best case scenario, 1.41 days on average volume. Let me say that again. Virgin Galactic stock SPCE has a certain amount of shares short, and it would take 1.41 trading days for those shorts to completely get out of their positions if the stock traded at average volume. All right. I just said the same thing twice, two different ways. 1.41 days if average volume. We had 10 times average volume on Friday. Do you understand what that means? I hope you understand that short squeeze is done. If in fact people panicked and got out and had a short squeeze and all of that, there's no more. There's not this. I mean, and that's the problem with the Wall Street bets, folks. They get in there like, well, there could be this, they come with all this deep due diligence reasons why the short squeeze could continue on forever. And with that logic, they explained why when GameStop was at $400 a share, that it still had a lot more to go. That it was a lot quicker. I mean, there was a lot longer. Those short squeezes were still coming. We never hit a new high on GameStop, right? Because most of the shorts found a way out rather quickly. I don't know, before or shortly after 400. I mean, hedge funds, these people, they got millions of dollars, billions of dollars, and they use some of that money on research for how to quickly execute trades and hedge their risk, et cetera, et cetera, et cetera. Don't kid yourself. If there's a serious problem in a short situation, it will get resolved as quickly as possible. In this case, we have evidence to recognize that the short squeeze is probably already done in SPCE. Already done. You just found out about it, it was over. It happened Friday. So that's a real good reason why I don't think SPCE is going to open higher and keep going. It might open higher, but my guess is it'll come back down. You'll still be able to get some at a lower price. Now, all that being said, doesn't mean it's a terrible trade. I mean, maybe it is, maybe it isn't, but it's still a gap. It doesn't really matter what the uh, what the reasons are that drove the gap. Over 10 years and 16,000 trades analyzed, the gaps perform this way. There is a reason. And in my class next week, I'm going to explain the reason why the gap trade is persistent, regardless of the fundamental driving reason that created it, and why you can trade it no matter what's going on. And that it leads to the reasons of why I'm showing you SPCE today. But again, I don't have the time to get into that, and you don't need to know that stuff in order to make a good trade. What you need to know is the stuff um, that really sets up the trade for your own personality, the way we're talking about, and that's what I want to try to show here in the next few minutes before the market opens. But let me continue with SPCE. Um, we see all this stuff about its actual performance in history, and then we see the stuff about the short float. Look instead now at ASTS. To do that, I think I have to open a. Um, oh no, ASTS. I'll save the trouble going there. Their data is not complete on short float. They've got some. It's okay, but it's like they don't have enough data for us to reliably compare the short float. But we do on CarMax. So let's look at that. That was the next one in the line right here. Look at how it compares. The short float is only 3%. That's not a huge amount. That's not enough to draw the attention of the Wall Street bets crowd and get these people all riled up and excited about trying to create a short squeeze, trying to band together and generate push a short squeeze into happening. But look at how many shares of the float there are. CarMax, it's a similar number, 162 million, and there's only 3% of it that is short. Okay, not that much. However, it also doesn't trade with 24 million shares of trade. This, on average, CarMax only trades with 1.9 million. So if for some reason the shorts decided they wanted to get out, it would take them at the normal time of the normal volume of trading, it would take 4.2 days for them to get out. Now, it's true we had triple the volume on Friday, but there's still some left. That's kind of the interesting thing. If in fact there were people that wanted to get out and that were short, there's a higher chance that they would create a follow-on action on CarMax today than that would also be true for Virgin Galactic. So that's the why I really think yes, the CarMax has a better chance of actually rising than SPCD than Virgin Galactic does. All right. Shukri asks, why do you think, or what do you think about Michael Burry's big short on Tesla and his doomsday prediction on losses bigger than countries? Um, well, I mean, you know, Mr. Burry is really uh, strongly has a lot of conviction about his ideas, and he let me get a chart up here where I can articulate this. Is this going to be the right one? I think I'm going to want to go with just chart 5 here. Okay, let's bring up uh, Tesla, and let's bring up uh, QQQ. No, no, okay. So you look at what happened um, with Tesla and Apple recently here. We see a similar pattern. Do you see this? This sort of comes down hard, hits some support, and goes running up. Comes down hard, same thing, right? That's because both of these are highly representative components of the tech industry, the tech sector rather, and the Nasdaq 100. These, Apple is something like 12% of the, well, maybe not that much now, but as far as its influence, Apple probably has about a 20% influence on the Nasdaq 100, meaning literally wherever Apple goes, that's where the Nasdaq's going. Wherever the Nasdaq's going, that's where the S&P 500 is going. So Apple is kind of the biggest, most important bellwether of all the stocks out there. Um, the second biggest is Microsoft, but the third biggest is Tesla. Yeah. So the idea that Tesla's going down, well, see, here's something interesting. You could see the Nasdaq go up and Tesla still go down because Tesla's so much more volatile, right? It jumps all over the place, and there's so many dynamics. There's so much speculation associated with Tesla, whereas Apple there's less speculation. I mean, all the market is speculation to some degree, but everybody has beliefs about Apple that are similar to each other, um, more similar than their beliefs about Tesla. So, the most highly informed analyst and the least informed trader. Let's suppose there's this gap between what this guy knows about Apple and what this guy knows about Apple. There's some gap, and I don't know whether you want to say it's like this, however, but there's this difference, right? Um, that difference compared to the difference between Tesla, right? What the best informed analyst knows about Tesla and the best informed or the least informed trader in Tesla knows. That is bigger. There's more information, a wider variety of information, and their beliefs could be farther and farther apart than they're likely to be about Apple. That's what I'm trying to describe. And so Tesla has therefore more variation in price. And if Michael Burry thinks all of the market, which I've actually heard him say, I've heard other people attribute to him, that he thinks all of the market is overvalued and that it's headed down, well, then Tesla's an obvious good bet because Tesla's got all of this possible variation. Even if he's wrong, it could still come down. He could still catch a good trade. Now he might think, "Are you kidding? No, Tesla is just, I, you know, Christian Bale playing him in The Big Short, right? Stupid." So um, he I'm sure has all sorts of things to roll his eyes over on Tesla. There are crazy CEO, too much government subsidy that may or may not hang around, an unproven market, ridiculously high valuation, right? All of that. On the other hand, hey, it could be Amazon. It could be the car maker of the future, and Tesla could end up being a $6,000 stock one day, right? You don't know. It could be anything. But if you had to pick on one, if you had strong beliefs that you felt like the U.S. market was going to be lower in value at some point in the future, a year, 2, 3 years, Burry plays a long game. He's not a trader. He's a get in there and hold. He was in, the Big Short, well early in 2007, mid 2007, and he had to put up with a lot of pain as his positions went against him, and then turn around. Any of these guys who've made fantastic calls and gone short at the right time of the market, they've had to endure that pain. That's the nature of that game, and most people can't. For every Michael Burry out there that had great research and had the nerves of steel to hold through it, there are probably 10 guys that bailed on their positions, and missed the trade that they saw coming. I knew plenty of them that could see it coming, that knew it was coming, but they didn't know when, and they didn't know how much to bet, and they didn't know which securities to go after. We talk about Michael Burry today because he did, and he had the mental fortitude, some might say craziness, to stay with it, right? Would you have the mental fortitude and craziness to stay with a long-term short trade against Tesla? I wouldn't. I don't. Quick short trades? Oh yeah. I'm all about that. A quick swing trade to the downside on Tesla sounds fantastic to me because of all the same things that we're talking about. So what do I think about Michael Burry's trade? I would have to have a lot more conviction than he does to get in it and stay in it and stay short. To take advantage of quick drops, absolutely. I believe that what's going to happen through the summer is that the tech stocks are going to sort of find support, bounce up a little bit, get knocked down, head up a little bit, and back and forth. And in the fall, we'll probably head higher. And so I don't like the idea of trying to put up with all of that by putting on a short and staying on it, doing Michael Burry's trade. Watching as it hits resistance, buying a put option or a put calendar spread or something to play that to the downside over the course of 1 to 2 weeks. Love that idea. I think Tesla's a great one for that. I wouldn't do that on Apple. I'm generally long on Apple, in terms of my expectations for that. Okay. Hope that answers your question, Shukri. Thanks. Fantastic question. Now, we're running down to the last 15 minutes. I'm going to quickly pop over to uh, the Nasdaq and Aussie yen comparison. We see that the Aussie yen is starting to come up, and the Nasdaq is continuing to come up. So the something's got to give. What's going to happen? What's happening? It looks like Aussie yen coming to catch up to the Nasdaq. That's what it looks like. All the more reason I think this supports my thesis that the Nasdaq is likely to drift higher today, from the open. I mean, we saw it last week. It sort of came down, but then it turned around and went right up for the day. I think we could be in for a repeat, of that kind of scenario. How early was he made the predictions on GameStop? 6 months, Shukri. He was short or long GameStop 6 months before January. Way early, right? Now maybe you know that, and you're kind of pointing that out to me. I don't know. If you don't know that, yeah, he was at least 6 months, yeah, early, before GameStop really took off. So he had to sit through a lot of push down. I mean, the guy makes trades with specifically with a time frame of 2 years. He wants to be in it, and he's willing to sit on it for 2 years. Um, uh, that's what value investors do, and that's what he is. He's a value investor. So if he bought GameStop, it was the idea that he was going to sit on it for 2 years. And so yeah, 6 months ahead of everybody else, on that GameStop trade for him. Um, and so Nasdaq drifting higher, Aussie yen catching up. Good. That's wind beneath our wings for these trades that we're talking about here with KMX, SPCE, and well, let's go look at those stocks really quick. How are they doing in the pre-market? I'm going to come over here. Here's SPCE. All right, so it closed Friday here. It has drifted higher, but been selling off. And notice that just this is I mean, SPCE is trading in the pre-market with enough volume that we can actually see some stuff going on here that's worth paying attention to. I mean, there's not volume like actual trading. That's still going to open, but these aren't just blips and dots. This is movement. And what do we got? We were up at 60. We're all the way down to 57. This as the Nasdaq had been going higher. So look, I told you even before we looked at this chart, I felt like SPCE is done. We do not have people panic bailing out of the short trade. And what is likely to do is likely to come down today at some point. Maybe it'll close higher today. I don't know. But whether it closes higher or closes lower, I think it's going to come down. So I think we can bargain shop this trade. We can try to buy a price lower than where it closed, below $56 per share. That would be my guess. You pick that up sometime over the next 5 days, and then you try to take profits in a setup that I'll show you. That's Virgin Galactic. How about CarMax, KMX? It doesn't trade as liquidly as SPCE. As you can see here, although this is a 5-minute chart, this is, I mean, hardly anything has happened. But we'll look where we are. We closed there on Friday. And since then, this is these little blips. It's so hard to tell. You can't really get a good read on this. We're 30 cents wide on the bid-ask spread, here by here. So it could open here, which means it's going to gap a little bit higher on that one. Remember, CarMax, if in fact there's a short squeeze going on, CarMax is more likely to have more people want to follow on from it. Also, I think it's important to point out, isn't the gap on, yeah, the CarMax gap is due from earnings. This other stuff is not an earnings follow on. So in other words, they posted good news. We go over here, we can see what it was. The estimate was $1.63 per share net earnings. That was what it was supposed to be. What they reported was $2.63. So a 60% surprise over and above the analysts' expectations. And people bought the stock at the open, and it fluctuated, but on the whole, they kept going higher for the day. So there's still a good chance. We've got both a combination of earnings and people being short. Oh man, would you hate to have been somebody who was short CarMax, and then that turned out for earnings, right? If that was you, then you're probably thinking, oh, you should probably just get out. And if there are enough people rolling their eyes and getting out of the trade, that's just going to push it higher for the day. So in the case of CarMax, I would not try to bargain shop it. I would just try to say, um, going up. And Helen says, I can't really see a gap on ASTS. Right. You can't see a window that is, white space from the old high to the new low, which is what I like to really see. And so it doesn't fill that criteria. But technically speaking, there is a gap. That is to say, it closed here at 970 and it opened here at 1010. That's the gap from body to body. Okay. The window that's what Steve Nissen called the difference between the candle's shadows, so that you get that opening. That's a window. The study that I was talking about didn't look for windows. It just looked for gaps. So the statistics would have included a trade like this one. Now I like the trades that have windows better, but statistically it's still in range. Helen says, okay then. Nice. And so ASTS, I would trade ASTS the exact same way as SPCE, but KMX, I think we trade just at the open, whatever it is. That's the way I would approach this. So let me show you how I would set those up. I'm going to go over here, and I don't know. I'm going to do this. Just make it simple. TradingView has this nice paper trading setup. So I've got my paper trading setup here. You could practice these trades. Let's show you how we would do that. So in the class, I'm going to talk about, I'm going to put on CarMax first because it's the one that's most time sensitive. So that, we got to get right and got to get it ready. In the class, I'm going to talk about why I would set trades up here. Some of you who are listening today have been to my class, and so you already know why I'm going to do this. But because I only got 6 minutes, I'm not going to explain why I'm taking the setups or the trade set up in the way I am. I'm going to risk 1% of the total account. That's actually very, very important. I'm going to set a stop loss down below the candle today. In fact, I'm going to come on Carmax, I'm going to come all the way down below the former high. We'll go 120.50. So the price 120.50, and we'll take that down one tick 49. Okay. So that is $7.41. Oh, I got it wrong. That's over here. Stop loss 120.49. There. $7.41. It says pips, like it's set up for currency or something, but you can just read that as pennies when you're and put the decimal point in right there. $7.41 lower than where it's last trading price is going to be. I'm just going to go that much lower to this amount, 120.55, and then I'm going to go half as much going up. I'm literally going to risk two to make one in terms of proportions. So 740, we'll go half of that. That's 375. $3, we'll call it 80 cents. Whoops, $3.80. And so the take profit number is $3.80 higher from wherever I get in. I'm not sure why that didn't take 3 point. Oh, it just rounded to 4. I see. So then what is that number? Why it should be higher than 128 to 127.96. Oh, that's 4 pips. Yeah, that's weird. Okay, I'm gonna have to set this. So 128 plus 4, 132. And then let me just bring that down a little, say there. Okay. And let's see if this will take. Now, the number of units has 29% risk. No, I don't want that. If I have a $200,000 account, then I would take 300 shares of this. If I had only a $20,000 account, I would take uh, about 30 shares of this. Anyway, I'm going to set this trade up this way with the stop loss at 120 and the take profit at 132. Show you where that is. Stop loss down here, take profit 132. That seems really high. Am I so high? 132, 137. I think that's because this is a logarithmic chart and it's showing me. Yeah, okay. Let me change that around a little bit. 132. Yeah, I want this distance to be twice as far this way as it is that way. And so, all right, we'll set that in. There it is. The order is placed. And I think that has a limit order on it though. I don't want that. Yeah, see, that's a buy limit. I actually want that to be a market order. I wonder if it'll let me do that. Modify the order, take profit by market. See, I think because it's pre-market, it's not going to allow me to change that. Darn it. So I want to change this number. Let's go a little higher. 128.50. Just in case. So anything, I'll take it all the way up to 128.50. All right, so it's a limit order, but it's a limit much higher than where the price is being quoted. At least I thought it was, right? 28.50. Yeah, 128.50 is going to be way up there. So for sure, it should act just like a market order. Okay. Are we trading Tesla stock or options? I would do options. Hi, Gordon. Can you bring him as guest if possible? You mentioned about a value investor in GME as early as, oh, Michael Burry. No, I couldn't bring Michael Burry on as a guest. Well, I mean, if I could find a connection to him and I would ask and he would come on here, but I would be shocked if he did. But you know what I could probably do is go find a value investor that thinks like Michael does, that kind of trades that way, and try to bring him in and see what we can do. But no, I couldn't bring Michael Burry on as a guest because I have no connection to him, and It's not in his nature or personality to come on shows like this. We might be able to do the next best thing, and that is bring up a few internet videos that would show this. All right, so we're live. Let's see whether the KMX trade works or not. In theory, we should jump right in with that trade. So positions for, sure enough, that put us in the trade with a last price, fill price, 127.99. So we took that trade here at 128 on KMX. And what did it do? It jumped right up there, hit 120. Anyway, that's right where our trade got filled. I don't know who got the first tick. Lucky them. We got the second. We'll see how that plays out. While we're waiting for that, okay, first tick down, no worries. We got lots of room there. While we're waiting to see where that goes, we're going to go check out SPCE, and we're going to try to put on SPCE now. Yes, it gapped up higher, but see how it's coming down, right? Coming down. We're going to anticipate that it's probably going to trade into this area here, 43, 44, or sorry, 53, 54, somewhere down there, kind of low. I don't know if it'll get that low. 56, yeah, I'm going to give it a try at 54. Okay, so let's set up this trade. Let's say we wanted in at 54, no higher. Now, if you wanted to be a serious bargain shopper, you'd be way down here around 52. You never want to try to put in a trade more than halfway below this gap up candle, just because the percentage of time that you'll actually get in the trade is so low. I mean, there are plenty of times where you could grab that trade, but it doesn't have a percentage, a higher percentage of winning than trades that are done up here. In fact, the higher you get in, marginally higher, statistically higher that you would get in. So anyway, I'm going to trade, try to capture that one at 54, and then do a take profit and a stop loss. Where I risk 2 to make 1, I want the stop loss to be down here at 45. So if the price is at 45, we'll call it 50. Actually, let's call it 25. 45, 25, and that's 875. So then I want to be $4 higher from where I get in. That's going to be about 58. We'll call it 25. There we go. And then I want to risk only 1% or thereabouts, 250 shares. Perfect. All right, so I'm going to take a 250 share on paper order at a limit of 54. And then we won't be able to know how that's going to play out until we come back next week and see, whether or not it worked. In other words, I'm going to give it all the way down to here, but I'm going to take profit even if it just gets right there. See, this risk 2 to make 1 gives me a baseline default of 66.7% winning chance. And if I have a little bit of edge, like I always do on the gap, then I'm going to end up with a 70% chance of winning. That's where that number came from at the beginning of this presentation. So let me put that order on, and we'll see if it goes down and fills that. And ASTS, my hypothesis was that ASTS was going to do whatever Virgin Galactic did. And look at that, it's trading to the downside. Same kind of setup here. If you wanted to do this, you would be better off, trying to bargain shop. We'll call it 1036. I like that idea. 1036. And then where's the stop? So the stop, in this case, we better give it some room. We better give it down to there. Let's give it a whole dollar, 936. And then we will take 50 cents. If we get just 50 cents on ASTS, we want to, I mean, yeah, look, it could go, right? So what you do is once you get filled, you watch the next day or two. And if you feel like, hey, it's going to run up and make a new high, fine. Take profit, or maybe even don't put it on to begin with and let it run. But mentally, at least, if not actually, you should put on this take profit order. Some, like take half of it off and let the others run, right? I'm keeping it simple. I'm just in at 9 or in at 1036. Is that where are we already there? It's down. No, it's not quite there. Now in at 1036. out at either 936 or 1086, and then the risk 1%, that's calculated on a $200,000 account. That's going to be 2,000 shares. I'll go 2,100 just for the sake of having a round number in that. Still close to the 1% risk. Okay. And there we go. That's the order placed. Okay, so those are my three trade setups. I've got them tracking and paper trading, and then we'll come back and look at them next week and see how did they perform. Um, it was fun last week when we were able to say, boom, I'm in, I'm out, just that quick. Looks like CarMax, the trade's coming against me from the beginning. So unlike Smith and Wesson, where it just jumped in and got right out, CarMax is not doing that. CarMax coming against us. No worries. We've got um, all the way down to here, and we totally expect these gap trades. All three of these trades are doing what is more typical for gap trades. They sell off a bit, you can pick them up at a lower price, and then you get the move over the next several days. So we'll see how they play out, and hopefully, if you recognize what we're doing, 1% risk per trade, right? That's the thing. And Helen says, "Well, we see how they did next week." Well, hopefully that is interesting. Yeah, it was too bad that we didn't get to see them, hit and happen here. But next weekend before these come off, I'm actually going to be going through the class. So if you end up hearing this presentation and you think this is really interesting, I want to fully understand this as a trading system, and how can I set up trades that win 70% of the time, even if the first thing to do is come back against me, right? How can I be that confident? Well, attend the class and you'll hear all of the full detail and the depths about why this happens year in, year out, why gap trading is a persistent edge that you can trade from, along with at least two other edges. One, I mentioned the tall range, and another one, which I'll show you about with Keltner channels. And it will really be worth your time. I can feel very certain and promising that, because I've traded this. I mean, I've taught this a lot, and people love it. It's very, very high um, satisfaction uh, feedback, and more importantly, the people that I've worked with one-on-one have an extremely high, above average um, uh, incidence of having improved their trading and improving their returns by using this knowledge. So I hope I get to see as many people as possible hearing this, joining up with us on that class. Um, Check out the Actions to Wealth page, and you'll be able to see where, in fact, that you can sign up for that. Until next week, everyone, take care and trade